Sales prices on homes remain high. Interest rates are expensive for mortgages, and the last time that we saw rates this high was in the early 2000s. Adding insult to injury, borrowing is extremely likely to become even more expensive over the next 12 months, making the decision even more difficult for those who may need to buy within the next year. It's conceivable that buying sooner rather than later could save money on interest rates, but it's tough to see how a buyer, especially a first-time home buyer, wins in this market. For more information on what the three large Wall Street banks are saying about home values, check out the video in the card above or at the end of this video. And if this is your first time visiting this channel, welcome. So glad to have you here. This is your new go-to place for little-known secrets on paying less money in taxes, getting the lowest interest rate available on your mortgage, as well as proven strategies to save and grow money. If you find this channel helpful, please subscribe and click that bell right there to get notified. Also, help us get some love from the YouTube algorithm by liking this video below and sharing a comment. Make sure to stick around towards the end where I share what you can expect rates to do headed into 2023, as well as whether or not it is a good time to buy a home. Over the past 2 years, the housing market has experienced extreme demand and limited supply, which has led to massive price hikes over a short period. And at the same time, inflation has ballooned across the world, including here in the US. So to get inflation under control, the Federal Reserve started raising interest rates in March of 22, making borrowing more expensive on top of higher base prices for homes. How will these rate hikes impact the housing market? Will interest rates continue to go up, or will the bottom of the housing market fall out completely? We have a lot to cover, so let's dive in, starting right now. Hello and welcome to Ask the Lender. My name is Rod Ferrier. I'm a licensed loan originator, and I created this channel to educate my audience while sharing my 2 cents about what's happening. I lived through the 2008 housing market crash as a loan officer, and I see firsthand what is happening right now behind the scenes. How is today's landscape different from just 2 years ago? In 2020, the average list price on an American home was $374,500, with average interest rates on a 30-year fix sitting at 3.11%. Today, the average interest rate is 7.06%, with average home prices up to $525,000. That means if you purchased a home just 2 years ago with a 30-year mortgage and 20% down, the average purchase would have cost you $536,551 in principal and interest over the course of your loan. The average purchase in the current market, though, would cost you $1.11 million in principal and interest over the course of a 30-year mortgage with 20% down. That's a difference of over $500,000 by the time you're done paying off your mortgage. That, my friends, is a ton of money. Interest rates are higher today because the Federal Reserve is attempting to curb inflation. Well, they're pretty clueless, but prices are higher for a few reasons. First, the U.S. was in a housing shortage prior to the pandemic. This put us in an already bad position when things took a turn for the worse. During the pandemic, many white-collar workers decided to relocate with a newfound freedom of remote work. Many moved to less expensive locations, and this also increased demand and drove up prices via bidding wars. Now, the Fed also contributed and created this monster by keeping rates artificially low for a 2-year period. Almost anyone with a decent job could afford to buy a house. So are home prices going down? It's kind of early to decide, across the board if home prices are on a downward trend, but it does appear that they are. While home prices tend to have a seasonal downward shift as summer wears on, this year the numbers were larger than average. Usually we see a decrease of 2% from June through August, but this year that decrease was 6%. Now that does seem promising for would-be homebuyers. Still, it's important to look at these numbers in context. In August of 2022, prices were 7.7% higher than they were at the same time in 2021. So from a longer-term perspective, home prices could still be rising. We'll have to wait to see the fall and winter numbers into next year to have a more definitive answer. Prices remain so high because there is a shortage of inventory still. While new builds did increase 12.2% in August, we can attribute this partially to supply chain issues. See, many builders were unable to get the supplies they needed to work on their projects, and many of these supplies finally made it to them at the tail end of summer in one big burst. Just because we saw new builds go up last month doesn't mean they're going to increase inventory for American families. The bulk of the increase in inventory will be in the commercial markets, would-be landlords looking to rent new units to tenants. Many Americans have been priced out of the market as home prices have skyrocketed over these past 2 years. That means there is more demand in the rental market than usual, so that's where developers have been focusing their energy and putting their money. If we look at multifamily housing projects with 5 units or more exclusively, new builds skyrocketed up 28.6%. Another reason this temporary uptick shouldn't be interpreted as a cause to relax is that permits for future home building projects were down 10% at the end of summer. As we look forward, we can expect to see even tighter inventory in the affordable housing market as a result, even as homes at higher price points sit on the market for months at a time. With less demand at higher price points, fewer potential sellers are eager to list. The opportunity that was there last year has diminished. With homes sitting on the market longer, sales on homes listed between $250,000 and $500,000 fell 14% from 2021 to 2022, partially because there's less inventory in this price bracket with rising home prices. But sales on more expensive homes were down too. Those with list prices between $750,000 and $1 million were down 3%. Higher priced and less affordable inventory aren't the only reason people have slowed on home buying in 2022, though. There's also the issue of federal interest rate hikes. This brings us to mortgage rates. First, if you or someone you know are in the market to buy a home and want a rate quote or a second opinion, please reach out to me. You can comment below or contact me directly. I put my contact information in the description. Starting in March of 2022, the Federal Reserve started raising interest rates. That makes borrowing, including borrowing via mortgage, more expensive. On Wednesday, September 21st, 2022, the Fed announced another rate hike of 0.75%. That makes the current federal funds rate 3% to 3.25%, and it is only expected to rise. We're likely to see another 2 rounds of rate hikes, totaling an additional 1.25 percentage points by the end of 22. The Fed is currently hinting that rates could rise as high as 4.6% in 2023, and estimates as of early October 2022 put the average 30-year mortgage at 7.06%. While it's reasonable to expect rates to shoot up even higher, just how much higher remains to be seen. Increased borrowing rates doesn't just discourage buyers. Higher rates also discourage sellers from even listing the properties in the first place, further compounding the supply side shortage. Many of these sellers would presumably be taking out new mortgages when they sell their old home. Most Americans with a mortgage secured rates when they were lower than 6%, so listing their property could mean increasing their financing cost on any new property. Should you buy now or wait? It's possible that buying sooner rather than later could save money on interest rates. If home values decline 10 to 20% and interest rates continue to go up, then buying now is a better option. Waiting could see you paying more money for less home. Whether prices go up or down is going to be highly variable depending on your local market. There may not be a nationwide pricing increase, but rates are likely to rise throughout 2023 until the Fed's target rate of 4.6% is reached. That's assuming they don't raise that number again, because they've been doing that. After that, rates may stay high for a while or be pulled back down, depending on how inflation looks. It's near impossible to predict what supply and demand will look like at that point. If you don't need to move right away, you may decide to wait until later next year or 2024 or whenever the Fed starts lowering rates again. There is more risk and uncertainty on the pricing equation that far out. Remember that the effects of the current rate hikes won't play out for another 18 to 24 months, and it is likely that the Fed will have to reverse course by mid-2023, maybe spring or summer of next year. If you have found this information helpful, make sure to smash that subscribe button, click that bell right there to receive notifications when new content is published. Want to know more about what the 3 large Wall Street banks are saying about home prices? Check out that video right there below. And we'll see you next time on Ask the Lender.